The IMF and the World Bank are meeting amid fears of global recession. What can we expect in the months ahead? Hello, I'm Anand Naidu, and this is The Heat. In the next 4 years, losses from a potential worldwide recession could equal the equivalent of the German economy. That's the prediction of the managing director of the International Monetary Fund, Kristalina Georgieva. The annual IMF and World Bank meetings are underway right here in Washington, D.C. The meetings bring together central bankers, finance ministers, banking executives, and NGO leaders to take on global economic and financial issues. CGTN's Jim Spellman reports.
The IMF and World Bank meetings are being held fully in person for the first time since the COVID-19 pandemic closed down much of the world. The meetings come as the global economy faces a complex mix of challenges. COVID-19 continues to present challenges to supply chains and impact the overall economic picture. The climate crisis is impacting all continents, and the ongoing conflict in Ukraine is driving up energy costs and contributing to soaring global inflation.
We cannot afford inflation to be a runaway train. And so we are risking, if we don't have strong action for this to happen. But it is a very, very difficult road to navigate.
Central banks around the world have been steadily raising rates to levels not seen in decades. The U.S. Federal Reserve has raised rates 3.25%. That will likely increase to 4.4% by the end of the year. In the UK, the Bank of England raised rates from 1.75% to 2.25% in September, and the European Central Bank is expected to raise rates again later this month by another 75 basis points. Still, the IMF warns it may not be enough to head off recession.
The risk of recession has gone up. We have calculated that about 1/3 equivalent of the world economy would have at least 2 consecutive quarters of negative growth this year, next year, and that the total amount that would be wiped out by the slowdown of the world economy is going to be, between now and 2026, $4 trillion. This is the size of Germany GDP.
On Tuesday, the IMF will release its annual World Economic Outlook. The managing director said last week that she expects to see the current growth projections of 2.9% for 2023 to be lowered. Jim Spellman, CGTN, Washington.
To talk about the global economic situation, let's bring in our panel. From Portland in Oregon, Yan Liang is endowed chair and professor of economics at Willamette University. Also from the West Coast, from Los Angeles, Ryan Patel is a global business executive. From Sao Paulo, Gilson Schwartz is a professor of economics at the University of Sao Paulo, and John Gung is professor of economics at the University of International Business and Economics. He joins us from Beijing. Welcome to all of you. And Yan Liang, let me start with you. Listening to the managing director of the IMF there, not a pretty picture, not very optimistic about the world economic outlook. In fact, she said that over the next probably 3 or 4 years, we're going to see the global economy shrink by about $4 trillion, which, as she pointed out, is the equivalent of the German economy right now. Firstly, can you pinpoint what exactly is causing this crisis right now?
Good to talk to you, Anand. Indeed, I think the IMF analysis is very sobering and it's very dire. And I think some of the major reasons, as we all know, one has to do with the pandemic and the very fragile recovery. Second has to do with Russia's aggression in Ukraine. And third, of course, has to do with the policy errors, as the United Nations has pointed out, that many of the developed countries like the United States, UK, and European unions are raising interest rates very abruptly and very drastically. And so all these are, I think, the perfect storm to basically slow down the economic growth in many countries. Not to mention, with the very strong dollar, with the rising rates, this really puts many countries in very severe situations in terms of looming debt crises. according to the United Nations Crisis Group, right now 46 countries are severely exposed to multiple crises, be it public health and also food and energy crises, and now debt crises. And another 48 countries are also seriously exposed to more than one crisis. So I think this sort of looming recessions globally has a lot to do with policy errors.
So Yan Liang, as you say, it's a perfect storm, and you add to that, of course, inflation, food shortages, energy prices rising as well, interest rates, as we know, are going up too. I mean, when we look at the situation now, what do you see as the immediate measures that can be taken to try and fix this, sort of the triage that can be taken in the short term?
Right. So, well, first of all, I think the most important thing, of course, is to strike a peace deal between Russia and Ukraine and end the war. And I think that is very significant, not only for geopolitical reasons, for human reasons, but also for economic reasons. And second is we got to have better tools to deal with inflation. I understand that inflation is a big problem, but I think raising interest rate to fight inflation is really a wrong remedy, and the remedy is even worse than the disease itself. And finally, I think it's really important to help with developing countries. I think the global leadership has been really failing in terms of providing vaccines to the developing world, to provide debt relief, to provide food and energy assistance to developing world. So I think, for example, IMF needs to do more. Last year they have issued a lot more billions of dollars of SDRs, and this year this has not happened. So I think the global the leading countries really need to take initiatives to help to both correct the policy measures, but also to help the developing world.
Gung, the former United States Treasury Secretary Lawrence Summers, he wrote a piece on the current crisis in the Washington Post that's being discussed quite a bit. And of course, his outlook was very pessimistic as well. And I'll quote to you some of what he had to say. He said, quoting here, "It is likely that in the next year, the United States will go into recession. Europe will be battered by high energy costs, and China will suffer its lowest growth in decades." So, John, given that and given the situation right now, what is your expectation for the Chinese economy in, let's say, the year ahead?
Well, first, let me start by saying that I totally agree with him that the entire world is entering into recession. There are many policy space here. The economy in the United States has been the combination of a couple of things. First of all, the United States economy has been in this era of low interest rate for a long, long time. So it's been feeding the demand side, creating an excessive demand. And on top of this, we have rounds and rounds of economic reliefs. Basically, in my view, it's a money printing scheme implemented in Washington, and again feeding up to the excess on the demand side, and then you have the inflationary pressure coming from the supply chain problems because of the war in Ukraine. The commodity prices have been pumped up, so you have this problem of excessive demand, grossly exceeding supply. In China's problem, it's kind of the opposite, actually. It's because of inadequate demand, because of the COVID policies here, because of the situation related to that. So I see the problem's a little bit different, and I think probably the Chinese economy is the only place in the world right now still undergoing a expansionary monetary and fiscal policies. The monetary policy is not very effective because the corporate world is not so much interested in taking on more debt. But I think the fiscal policy is still working. But the root problem is the restrictions related to COVID policies, and I think there's a need to reassess this policy, and in hope of that these strategic policies will be gone soon, so as to be at least Chinese economy can be an engine of growth again, for the rest of the world. And let me also add one very important comment here. I totally agree with Yang Liang that there should be peace negotiated in Ukraine, at least to issue the problem of commodity prices. But let me say the following. I totally agree with President Joe Biden regarding the situation at the OPEC Plus. I think this group is totally irresponsible for maintaining such a high price by cutting back oil production at this point, in disregard of the global economic crisis we're entering into right now. I think they should take actions not take actions of cutting back oil supply. It's just adding fuel. By cutting oil supply, but it's actually adding fuel to the already very dire economic situation around the globe. And I think this is something that they did totally responsibly.
Ryan Patel, I want to talk about the role that the pandemic has had in this crisis that we're seeing right now. But first, I just want to get back to the point that John made a moment ago about OPEC's decision to cut back on production and what that is doing to global output around the world. What do you make of it?
Yeah, I mean, I think I agree. It is hurting. Like here in the U.S., you can see it's providing a frenzy of not just the pricing, but it changes consumer behavior. When you think about fourth quarter, especially in the U.S. and globally, typically it's holiday shopping. You think about, more spending, travel. This is going to have, could potentially have an impact how people choose to spend. And if consumer spending is here in the U.S., 60+% of the GDP is of that. And when you think about the global economy, we look at tourism in general. We see countries of the emerging markets like Egypt and those hurting real bad. It is going to make an impact, and it's going to. This is not long. We're feeling this in the short-term aspects because of the pricing. So I think this is also providing a lot of geopolitical tension behind this, and how economies are not set up or maybe too focused on oil-based too, and you see energy also increasing in pricing.
Ryan, the other thing I want to talk about is the role the pandemic has played in this crisis right now. So we had the pandemic towards the end of 2019, beginning of 2020, when the virus swept the globe. Governments around the world implemented stimulus measures to try and invigorate slowing economies, but now we're seeing that economies have overheated, and now we see inflation rising as well. Now measures are being taken to cool down these overheated economies. Was it a bit too much stimulus, do you think, at that point?
Well, I think it was a whole bunch of different things. I think obviously it's true that the inflation and overstimulus happened. I mean, when the IMF 4 quarters in a row downgrades the GDP, that tells you of the global economy. It tells you that the prediction of the predictability is not there, and that should get some worrisome behind it. I think the pandemic also has caused the economies to have to evolve. Like there's no going back on it. I think part of this overheating process is a learned lesson for many of these economies to be more efficient, to be more resourceful, to create businesses as well, to change their models. Like this is a lesson that is an expensive lesson to be learned, but also for the future of work, the future you've been doing business with other countries, and the way that countries import and export, even with supply chain issues. If we haven't learned from that, we are going to have a slow recovery when it comes to a global aspect. So I feel like the lesson has been learned, and I think that needs to be implemented fairly quickly by a global community.
And Ryan, what do you make of the manner in which interest rates are being pushed up? I mean, it's a bit of a balancing act, isn't it?
It's a balancing act, unfortunately, though, and that's the tool that they're pulling on because it's too late, right? They're going really hard at it because they're trying to make sure that doesn't become an imbalance. And unfortunately, we're seeing these interest rates over quarter to quarter going higher and higher because of the instability and unpredictability. And unfortunately, we are interconnected. And you know that I've mentioned this before, when the UK, Europe, Asia and the U.S., they're all in this kind of it together. And that balancing act is not just for one country. So I think it is unfortunate that is the button that they're pressing on. But I don't think that because of the catch up that they have to do, that's why they're leaning on that.
Jilton Schwartz, great to have you with us on the show. The IMF Managing Director, Kristalina Georgieva, whom we saw earlier at the beginning of the program, she's also been talking about the need to curb inflation. Let's listen to some of what she had to say.
Inflation is very stubborn, and now we see transmission into core inflation of the high energy and food prices. Unless central banks get that under control, we undermine the foundation for growth. And who pays the biggest price the poor people. It is a tax on them.
So, Jolson, as we hear there, it's the poor who are going to pay the biggest price for inflation right now. But I'm wondering, what kind of real-world impact is it going to have among low-income groups? Because, if we look at inflation rising, then we look at the other things that I mentioned as well, food insecurity, the continuing threat from the pandemic. What impact will it have?
Well, as an economist who's been living and working in Brazil and been through several IMF packages, I would say, very frankly, that IMF is still the old IMF. That is, wrong theory or no theory at all, insufficient funding, and then ideological guidelines. Let me explain what I mean by that. I watched this presentation this morning, and it's really, and I've read the reports, at least parts of the reports that have already been published. And first of all, the IMF has no clue about what's really going on, because after the pandemic, it's such a disarray of supply chains. The inflationary process itself, it's both a demand problem, pent-up demand, and a supply problem. It's something unheard of. If you read the reports that have been published by the IMF, what you see is that they are saying themselves, they are saying this is totally unprecedented. We have no experience. They have looked into the statistics of previous inflationary periods or wage price connections, and they have no clue. They are frankly admitting that we need a new approach. Then, next, she mentioned the German GDP as a measure of what's going to be lost to this crisis. But another figure that she mentioned as well is the insufficiency of funds by the IMF and, by the way, the World Bank. The World Bank has stated today that they have about $800 billion to solve $4 trillion crisis. So it's clearly insufficient. And then, third step, after no theory and insufficient funding, they are saying that the only hope is private investment to recover. And that's the old mantra of the IMF, this belief that in the crisis, you take the state out of the game, you raise interest rates, and then you wait for the private sector to promote recovery. They have themselves acknowledged that private capital is flying to quality. With higher interest rates in the United States, it's clearly that the problem with the dollar is a result of central bank policies. And of course, as we've seen so many times over past history, at least in the 20th century, at least in the post-war period, waiting for the private sector to promote recovery is pure ideology. It's not going to happen. They themselves are acknowledging that there is a capital flight to quality, so that investors are now flying to the United States. They are flying to reap the benefits of this higher interest rates in the strong dollar. So it's nonsense. I don't see consistency in their analysis. I don't see the tools to fight the crisis. And then they are now again calling for us to hope that the private investment will by itself promote recovery, and then long-term changes as well, especially in the climate issue. So it's really frustrating. Sometimes I would say that's even pathetic, because it's a huge institution that again and again does mistakes. Analysis, diagnosis, has no enough funding, and then believes that the private sector will take us out of a $4 trillion crisis. But every investor knows that this is a moment to look for a haven. That's where the strong power takes us.
Yang Liang, what's your view on that? As Jolson points out, I mean, he's pointing out the shortcomings of what the IMF and World Bank are doing right now, and not enough to meet the needs of the crisis right now.
Absolutely. I would agree. I think, to solve the debt crisis is not to give these countries more debt, more loans with conditionalities attached. So I definitely agree. I think that we need different approach. We need different leadership to help us through this sort of crises. And I also just wanted to qualify a little bit my earlier claim that raising interest rate to fight inflation is really the wrong medicine. Because if you really look at the United States, yes, the pandemic relief was generous. Can we be a little bit more targeted? Yes. But let's not forget, this money really helps re-engineer the rebound of the economy when the economy lost about 1 million people due to the virus. And let's also not forget, when you look at the data, the U.S. personal spending has gone down by 10% sometime in 2021 and then quickly rebounded. So a lot of this demand is just pent-up demand. It's not really unusually high when you look at the historical sort of average. And it has a lot to do with, as the previous speaker talked about, the supply chain disruption, and all of these oil, energy, and food crises. So I think really when you're thinking about all this rhetoric about let's engineer a high interest rate hike and let's cool down the so-called employment and job markets, what you're essentially doing is to say, yeah, when the wage is growing by 6%, that's not okay. We have to kill that labor market, right? When the corporate profits are rising by 20%
right.
in 2021, rebounded very strongly, and yet that's somehow not going to add to inflation. So I think there are many other tools like strategic price control would do a much better job in controlling inflation without making the poor, the workers, right, really shoulder the burden.
John Gung, there was an opinion piece in the New York Times which made the case for concerted, joint international action to combat the crisis that we are facing right now, rather than individual countries taking actions individually. Do you agree with that? And is it workable? Because we're looking at a political environment right now, an international political environment that is very, very polarized.
Absolutely. Well, let me first comment on my good Professor Frank's comment. I tend to disagree a bit on this point. I think the inflation is a very stubborn, based on historical precedent. It takes resolute measures to contain it, and probably the most effective means is indeed interest rate hikes. And this is something that the Biden administration cannot afford not to do, because inflation is a political killer. With the midterm election around the corner and into the next presidential election season, this is something that has to do. So I think it doesn't have much of a policy choice here. Regarding your question about international coordination of this, I totally agree. The current situation is totally different from what happened in the 2008-2009 financial crisis, where the major central bank leaders sitting together come up with a policy to jointly battle this. Today we're facing a totally different world, and the problem is also very different here. I mean, as I explained, in China, we have a very different problem. We have inadequate demand versus the supply issue here. China is going to continue to adopt a expansionary fiscal policy. It's going to continue its expansionary monetary policy. So I think both from political as well as the economics policy perspective, it's very difficult to have a policy coordination on a scale of the 2008-2009 financial crisis. It's a totally different picture right now, and not even mentioning the political, the geopolitical, the political situation. The United States is taking on a grand competition against China. And we tend to have a slightly different view on this war in Ukraine. It's very difficult in my view.
Ryan, of course, when we talk about international coordination, I mean, to some extent, we are seeing that in action right now with these IMF and World Bank meetings taking place just down the road from where I'm sitting right now. But I mean, what really do you expect to come out of these meetings?
You so set me up for this question, didn't you? You know that we would I love to see more coordination? Absolutely. Do I believe we're going to see action that's actionable in a short-term term? I don't want to sound pessimistic, but yeah, I don't think so. I mean, there's, as John just mentioned too, there's so much geopolitical tensions of how to do, people worried about their seat, how do you help others in each of the countries? The answer to the question is yes. If we can all come together, get on the same page, and be able to solve this together. Yes, can we get there quicker? Absolutely. But there's so many variables that are happening in here, and I don't see us as a global community, unfortunately, getting through that when we see conflicts in other parts of the world, and we're trying to also help those that are in need at the same time and getting the right dollars there. So I'm sorry for not the greatest answer, but I hope we will. But I think that these meetings are more for awareness to the rest of the world and emerging markets that the future is still going to be some struggles ahead.
Gilson, one change that is being looked at by many countries around the world is to reduce their dependence on the US dollar as a reserve currency. I mean, recently, we've heard many analysts criticize the manner in which the United States used that power against Russia at the just after February 24th, when the conflict there took a turn. I mean, is it possible? I mean, is that realistic to say that, you know, dependence on the US dollar as a reserve currency can be reduced? I mean, what would replace it?
I think that the geopolitical situation is very much at the root of that kind of change. I don't see the geopolitical issues as minor problems. I think that we are going now through a major reshaping of the international order, and that the currency wars are not a novelty. We have seen many currency wars as part of geopolitical strategies. As I mentioned, high interest rates in the US mean that investors and capitalists, they tend to favor concentrating their investments in the United States. It's a geopolitical attitude. It's not only to fight inflation, so to speak, because there's no clear-cut diagnosis of that as a demand inflation. So I think that there is a geopolitical issue with the rising interest rates and keeping the dollar as the standard. Whereas at the birth of the IMF, a very simple idea, although very difficult to implement, was exactly currency coordination and the creation of an international currency that was also even of the United Kingdom at the time, and the US rejected, because what we need in order to issue currency is a global cooperation, which is what you're getting even farther away from that. But I agree that international cooperation requires global monetary reform. I remember that kind of issue was researched when we had the debt crisis in Latin America and developing countries. Everyone said it's not just a matter of balancing debt sheets. So that is really a major issue with what is hegemonic currency in the world system. We have been discussing monetary reform on a global scale. The IMF.
Gilson, I'm afraid I have to interrupt you there because we have run out of time. Thank you to all of you for being with us on the show. That is it for this edition of The Heat. I'm Anand Naidu in Washington, D.C., and thank you for watching.